The global financial system is facing structural cracks that require a massive sovereign revaluation of gold to absorb existing fiat debt. Stabilizing national balance sheets at these debt levels requires a deliberate accounting reset, where gold is used as the primary tool for systemic repair. This transition leads to a rapid devaluation of paper currencies, making defensive positioning in physical assets a logical response to the shifting monetary foundation. Since the move to a pure fiat system in 1971, global sovereign debt has expanded at a rate that far outpaces actual economic growth. This chart shows the consequence of that divergence. As debt issuance climbs, the resulting currency expansion is eroding the dollar's purchasing power. With a standard default likely to trigger systemic failure, restructuring debt by revaluing a physical reserve asset remains a viable remaining option for governments. China and other BRICS nations are currently front-running this transition by systematically reducing their holdings of U.S. treasuries. This map tracks the first stage of the strategy. Massive quantities of physical gold are exiting Western institutions and moving into Eastern vaults. China is also establishing newly built exchanges and independent cross-border settlement systems to bypass traditional dollar-based routes. These powers are accumulating gold as monetary insurance, intending to secure their position in a multipolar financial order. Economic models projecting a gold price near $30,000 are based on the requirements for partially backing the broad money supply. The specific target is reached by dividing total debt by official gold reserves. This creates a mandatory price floor that effectively zeroes out the debt on the government's balance sheet. A $30,000 gold price signals that the purchasing power of fiat currency has reached a point of exhaustion. Past international resets show that paper currency holders face immediate and significant losses when a new monetary baseline is established. This split screen models a reset. On the left, a $1 million fiat portfolio loses most of its utility. On the right, a gold portfolio carries no counterparty risk, and its valuation increases to reflect the new revalued purchasing power. Holding physical gold offers a potential path to maintain the liquidity needed to acquire distressed real estate and other assets if a reset occurs. The limits of the current system are visible in the debt data. Evaluate your exposure to paper assets.